Welcome to the 77th International Atlantic Economic Conference, and welcome to Madrid. For those I've not had perhaps a chance to meet, my name is Catherine Virgo. I'm the Society's Executive Vice President, and I'm also the Program Chair of these meetings. My late husband John was the founder of the Society and also the founder of its two journals, the Atlantic Economic Journal and International Advances in Economic Research. The reason that he founded the organization was to increase communication across the Atlantic and also trying to get more younger economists involved and having opportunities to present at meetings. Over the years, I think the need for increased communication has only grown stronger. We've been around now for over 40 years. We offer a venue for communication and publications. And I think also the nice thing about our organization is we're not so overly large that you feel lost when you come to our conferences. I think you do get a chance to meet a lot of the other people that are here, and it's more like a group of friends. So I think it's very nice. Well-known leaders from all over the world have participated in our conferences over the years. These have included Nobel laureates. In fact, approximately 20% of our past presidents have been Nobel laureates, included Larry Klein, James Meade, James Mirrlees, Robert Mundell, Ned Phelps. Approximately 300 people are on our program this year. We have people from countries all over the world, both well-established countries and new and developing countries. And so hopefully our discussions here at the meetings will bring a greater understanding of some of the challenges that the various countries meet or are facing. I see we still have folks that are joining us, so I'm going to go through some additional announcements here while everybody gets settled. First, I'd like to thank the people on the program committee, and you'll find those on page 6 of your program. They've worked very hard over these past many months organizing sessions for us. So trying to improve the quality of the program, so I've been very impressed. And you'll recognize the people that are on the program committee by the special ribbon that they have. Let's see, we still have a few more coming in. So I think what I'll do, I think we're far enough along now, I'm going to go ahead and start with some of the introductions of the head table. Looks like just about everybody's here. Point out one more thing. Our next conference is going to be in Savannah, Georgia, and you'll see this on the back cover of your program. It's a slightly different schedule than our normal North American meeting in that it's a like Sunday, Wednesday schedule, so I just want to point that out. The abstract submission system is already open. It opened on March the 15th and closes on April 30th. And though we do accept late submissions, I do encourage you to get your submissions in before that deadline expires because the submission fees increase after that point in time. So, all right, so without any further ado, I'd like to begin with introducing the head table. So I'm going to start with your far left. I'd like to introduce Jose Maria Montero Lorenzo. He's a professor at the University of Castilla-La Mancha here in Spain. He's currently a member of the IAS Executive Committee, and he's a longtime member of the IAER Board of Editors. Next to Jose is Pablo Cousteau. Pablo is the Director of Specialized Programs here at the Institute for Stock Exchange Studies. He and Jose are also members of our local program committee, and they have worked very hard planning the activities which will be going on tomorrow afternoon at the IAB, at the Stock Exchange, and also at the BBVA. And I do want to make one brief announcement right there. For the activities Friday afternoon, if you're attending those activities, please bring some form of picture ID with you when we go to the various venues Friday afternoon, because that is a requirement. If you don't have your ID, we may not be able to allow you in. So it doesn't have to be a passport, it can be a driver's license, it can be something else, but please bring some form of ID tomorrow afternoon. Okay, so now I'll continue on. The next gentleman at the head table in the center is Reinhard Neck. He's with the University of Klagenfurt in Austria. He currently serves on the IAES Executive Committee. He's our most recent past president, and he did a yeoman's job this past year organizing the Vienna meeting last April. So we're very pleased to have him at the head table. And he also was on the local program committee organizing the Vienna meeting in 2003. He's a longtime member of the IER Board of Editors as well. And then next to Reinhardt is Charlie Kalamiris. He's our current vice president, and he's the Henry Kaufman Professor of Financial Institutions at Columbia Business School, and he's a visiting fellow at the International Monetary Fund. And so now Charlie will take over the program. Thank you.
Thank you, Catherine. Catherine's already introduced our president, but Asla's instructed me to keep it short, but I'm pretty disobedient. And as I told her, this is one of those rare opportunities where you get to say nice things about someone that you really mean. So let me tell you a little bit about our president. She received her master's and PhD degrees in economics from Ohio State University and started off at the Cleveland Federal Reserve Bank and then moved, I won't say the exact year, to the World Bank as a young economist. And she has built quite a remarkable career at the World Bank with many different positions, including, pardon me, chief economist of the Financial and Private Sector Development Network, but now she's the director of research at the World Bank, which means she's one of the 2 or 3 top economists working at the bank today and in charge of the entire research function of the bank. Asli has written many books and has championed many initiatives at the World Bank that are really a series of volumes. Most recently, and something very relevant for her comments today, a book in 2007 called Finance for All, Policies and Pitfalls in Expanding Access. She also created the World Bank's Global Financial Development Report and directed the issues in 2013 and 2014. The one in 2013 was called Rethinking the Role of the State in Finance, and 2014, Financial Inclusion. Again, the subject of today's discussion. My personal favorite of the books that she edited is Deposit Insurance Around the World, which she co-edited with Luke Lavin at the IMF and our mutual close friend, Ed Kane. Of course, Asli is extremely prolific. She's had more than 100 publications, especially in academic refereed journals, especially in the top journals. She's one of the 2 or 3 most cited women economists in the world, and I think soon, given her productivity, will be undisputed the most cited woman economist in the world. She works on issues having to do with linkages between financial development, firm performance, bank performance, economic development. Some of her subject areas of particular focus are banking crises, financial regulation, access to financial services, which is the focus today. I won't go through much more detail in her publications except to say that for 2014 alone, she has 10 refereed journal publications. And what's more important and impressive than the number of publications is how interesting the titles are. How does competition affect bank systemic risk? Bank ownership and credit over the business cycle. Is lending by state banks less pro-cyclical? Has the global banking system become more fragile over time? How does deposit insurance affect bank risk? Who creates jobs in developing countries? Islamic finance and financial inclusion. Revisiting the state's role in finance and development. Bribe payments and innovation in developing countries. You get the idea. I won't review all of Asli's many awards, both external awards having to do with accomplishments as a writer and awards within the bank. But I will note that she's a member of the Journal of Financial Intermediation's editorial board, and I'm very proud that she is. Anyone who knows Asli knows that this record isn't really the thing that people appreciate most about her. What we appreciate most about her is her energy, her creativity, But more than that, her courage, her integrity, the fact that she's an outspoken advocate of what's right as she sees it, even in an organization which is vast and extremely bureaucratic. That does take courage, that does take integrity. And she's also a reliable and great friend. But of course, most of all today for us, a great credit to the International Atlantic Economic Society as its president. Please join me in welcoming her.
Thank you, Charlie, for this great introduction. Thanks, Kathy. And it's a great pleasure to be here with you today. And it's wonderful to be in Madrid, my first time as well. So let me... Okay. It's going slowly. Okay. All right. As Charlie mentioned, today's talk is on financial inclusion, and it is actually based on a significant synthesis work that we've done at the bank. It was the second feature topic of the Global Financial Development Report on financial inclusion. So let me tell you a little bit why financial inclusion. Clearly, financial inclusion is a topic of great policy interest, but it has also increased in importance over the last years. It's certainly moved up the policy agenda because G20 constantly talks about financial inclusion as well as other international fora. Our client countries, over 50 of them, have set up formal targets and strategies for financial inclusion. The President of the World Bank has set achieving universal financial access by 2020 as a target. Of all the bank regulators, 2/3 of them actually now have expanding financial inclusion as one of their targets. So the policy interest is undisputable. But also we know that access to finance plays a critical role in reducing poverty and improving growth in all fundamental development theories. We know that access to finance enables poor people to save and borrow, allowing them to build assets, invest in their education. Small and medium enterprises are able to take advantage of promising growth opportunities through being able to access finance. So this whole sort of being able to increase the livelihoods and improving growth, it hinges generally on ability to access financial system services, particularly credit. But the reason we're doing this study at this point is not because of the theoretical interest or importance. It's because there has been significant empirical advances in this area. First of all, we've been able to pull together a large cross-country database to benchmark financial inclusion around the world. And secondly, there has been a lot of sort of empirical work, both sort of analyzing this cross-country database, but also a lot of randomized evaluations and other rigorous empirical work to tell us about the impact of financial inclusion on development outcomes. So it sounded like it certainly felt like a very good time to bring all this empirical evidence and conceptual framework together to sort of provide a roadmap for financial inclusion for policymakers that is solidly based on empirical evidence. All right. So before we generally start doing a study like that, we also try to get a feel for global views by surveying informally our clients, which tend to come to our annual financial sector overview course, and they come from all around the world. They're generally financial sector experts. And when we asked them about access to finance and financial inclusion, certainly there was a recognition that this was a very important topic, but there was a lot of disagreement on how to address financial inclusion, how to sort of address issues around this topic, how to expand inclusion responsively. So we thought that this is, again, another important reason why we want to do this. All right, so it's important to define financial inclusion before we go ahead. We define financial inclusion as the share of individuals and firms that use financial services. But certainly this doesn't mean finance for all at all costs. We know that this could backfire significantly. What's important here is to realize that access to finance and use of finance are distinct concepts. So when you look at the population, it's fairly easy to see who's using financial services. But then even if people do not use formal financial services, you know that they could have access but may not use financial services because box one, they may have no need for financial services, or they may have cultural or religious reasons not to use financial services, or they may have indirect access. But then there are those who are involuntarily excluded. So, for example, those who do not have sufficient income, or they do not have viable sort of business models or ventures that should not be financed. So those are captured in the box 3 here, which are not of that much interest for us as policymakers. But certainly there are those who are excluded, who do want to use financial services, but they cannot because of discrimination, because of lack of information, weak contract enforcement, product features, etc. These are all symptoms of underlying structural issues. So perhaps because of the weak institutional environment or lack of competition and so on and so forth, you are not able to sort of serve this segment of the population that could otherwise be served. And those are the group of individuals that you want to reach through policies. So anyway, this also suggests that it's not only important to look at those who use financial services, but it's also important to get a feel for what are the barriers to use. So, having defined it, as I mentioned, it was interesting when we started this work about 10 years ago, when we tried to get some information on financial inclusion, access to finance, we really looked around and could not find any systematic evidence. Although financial sector is an area where you expect to be able to get a lot of very good data information. There's a daily or even hourly information on stock markets. When you wanted to see what sort of proportion of the population use what sort of financial services, there was nothing out there available. So 10 years ago, we tried to piece this information, impute this information, so on and so forth. But finally, in 2011, we were able to launch a new data set, Global Findex. We were able to do this in partnership with the Gates Foundation, who generously funded this work. And we, for the first time, designed a survey that was comparable all across the world and incorporated this into the Gallup World Poll. So for the first time, we have financial inclusion figures for 148 countries, over 150,000 adults, age 15 and above, representing 97% of the world's population. So it was possible to see who uses what type of financial services around the world, what are the differences across countries, etc. So this database is available on our website on an individual basis, also country-level information, as well as some correlates. So I do sort of encourage you to go and look at the database and see if you're interested to use it in your research. Well, what does this tell us? Basically, looking at this data for the first time, we can see that globally about 50% of the adults have a bank account. Having a bank account is sort of important, and this bank account in a formal institution. It's important because it's the first step in sort of being included in the formal financial sector. So the other 50%, about 2.5 billion, still remain unbanked, so to speak. And obviously, there are significant differences across countries. In high-income countries, about 89% of the population is included. In developing countries, this is about 41%. For example, in Africa, this is about a quarter of the population, although even in Africa, there's quite a bit of difference across different countries. You can also see that there are significant gender differences. In developing countries, 37% of women are included, whereas 46% of men are. In general, women tend to be about 15% less included than men. And there are many interesting correlates, which I won't get into right now. But here's a funny graph which sort of weighs the countries by the proportion of unbanked. So you can see that how different countries become much larger, regions become much larger when you do that. Okay, as I mentioned, it's important to sort of get a glimpse of what are some of the reasons people do not use financial services. And here, for the survey is interesting because for those people who do not have a formal bank account, we also go ahead and ask what are some of the reasons. Obviously, these are self-reported reasons, so you need to take them with a grain of salt, but regardless, they're interesting to look at. A large majority, about 30%, say that they do not use financial services or they don't have a formal bank account because they do not have enough money. But then there are other reasons as well, like the family member already having an account. This is the indirect access, presumably. Although studies do suggest that having an explicitly your own account has an important impact in terms of empowerment, so it's not a perfect substitute to be able to use somebody else's account. People do respond saying that the accounts are too expensive, the institutions are too far away, lack of documentation, lack of trust, religious reasons. Now, clearly, these are, as I said, subjective measures, but then we try to see to what extent these measures are correlated with more objective measures, such as the actual sort of fees that are charged by financial institutions, or the branch penetration, and so on and so forth, and even controlling for GDP per capita. We do find very significant correlations between these responses and the country level sort of potential barriers. So presumably these give good glimpses as to where some of the barriers lie with vis-a-vis inclusion. Okay, this is only the first sort of round of this data gathering exercise. So the beauty of partnering with the Gates Foundation is that they are going to be able to support this for the next 10 years. So we're going to be able to do various rounds every 3 years. So the next round of the financial inclusion survey is coming up next spring. So we will be able to not only benchmark this year, but also track how financial inclusion changes over the years to be able to see whether certain sort of policy interventions have any impact. But for now, just looking at sort of carefully looking at some partial correlations provides some interesting, again, relationships. We do see here, for example, as you'd expect, inclusion is associated with greater income, greater education, employment, being in the cities, and so on and so forth. But also, it's associated with a better enabling environment for accessing financial services, such as lower banking costs, greater proximity to financial service providers, fewer documentation requirements to open an account. And there is also some suggestive evidence that certain policies that the governments are adopting in their financial inclusion strategies may have some positive impacts, such as offering basic or low-fee accounts, granting exemptions from onerous documentation requirements, allowing correspondent banking, and using bank accounts to make government-to-person transfers. So these seem to be associated with greater inclusion of the segments of the society that are more likely to be excluded, like the poor or the rural individuals. Okay, so again, looking at some of these correlations more carefully, clearly inclusion, having an account in a formal institution increases with the GDP per capita, so much so that as income increases, actually inclusion becomes universal. But what's more interesting, I think, in this figure is that early on, at lower levels of GDP per capita, there's a huge dispersion. So it's not only income, there are other things, potentially policies, that could make a difference. The other interesting point to point out here is, as you know, there is worldwide greater interest in inequality these days. Clearly, when you look at financial inequality and economic inequality, you do see a strong correlation as well. The account penetration in the richest 20%, as a multiple of that in the poorest 20%, tends to be strongly correlated with income inequality. So some of these relationships, the causality of these relationships, will need to wait for us to have better panel data. But still, there's, again, suggestive evidence that these things go hand in hand. Okay, so talking about more rigorous sort of studies now, the study that we have done actually is also a very significant sort of synthesis of all the evidence that we have from various impact evaluations, randomized or not, trying to understand some of the sort of impact on development policies, and distilling all this rigorous impact evaluations and other evaluations suggests a number of sort of lessons. First, obviously, one thing that to keep in mind is that the empirical evidence on impact varies by the type of financial service. Because when we talk about financial inclusion, we don't only talk about financial access to credit. That, although that's what we often have in the back of our minds, it also sort of covers basic payments and savings services, as well as insurance. So when we look at the impact of being able to use these different sort of financial services on development outcomes, we do see differential impact. For example, when we look at basic payments and savings, there is certainly strong evidence on the benefits, especially for the poor. There are studies both within the bank and outside the bank that suggest that having access to basic payments and savings account increases savings, leads to more productive investment, greater empowerment, particularly for the women, and greater even health benefits. So that seems to be a no-brainer in terms of the importance. When you look at insurance products, there is also, particularly this has been sort of studied in the context of agricultural insurance. And also there is some evidence of positive impact when insurance products are used. There the challenge seems to be take-up, which I will mention in a moment. Now, when it comes to access to credit, though, the picture is a bit more mixed. there, there is a very sort of extensive literature when you look at firms. Access to finance by firms is clearly a very important aspect of the growth process. It has important implications for startups, small and medium enterprises, for entrepreneurship. So I don't think there is much of a discussion there. But when it comes to micro enterprises and individuals, the story is slightly different. The initial narrative that was sort of promoted by Yunus that the microfinance or microcredit is supposed to unleash the productive potential of the poor and would lead to significant growth and lift everybody out of poverty, has not really materialized. One of the reasons for that is that micro entrepreneurs tend to be a heterogeneous group. They're not all interested in investing, but they are actually interested in using microcredit for risk management and consumption smoothing, which is obviously very important in terms of welfare. And at the macro level, too, there are now studies that suggest that microcredit is not necessarily significantly associated with aggregate level of investment or growth. So there is a greater understanding that it is a redistributive tool and therefore could be very valuable. However, the message needs to be more nuanced and understood in a different context. All right, so what do we say then in terms of financial inclusion policy? What does findings from overall research do? I mean, this is an important part of being in the World Bank because oftentimes policymakers tend to sort of jump to conclusions. Just because financial inclusion could be good in certain cases, there could be a lot of policy interventions which actually may end up backfiring. So some of my work is to ensure that the interventions that are designed in order to do something good does not end up backfiring and actually leading to crises or such sort of unforeseen and undesirable events. So the point that needs to be stressed as a result of all this empirical and theoretical work is that policy to address financial inclusion should focus on addressing market and government failures. So it's not really to promote inclusion for inclusion's sake, and certainly not for making everybody borrow. We know from the latest financial crisis that could badly backfire. And the other important point is direct government interventions in credit markets tend to be politicized and less successful, particularly in weak institutional environments. And this was the topic of the report previous to this one. So, and there's going to be a panel actually this afternoon discussing the role of the state in finance, which will touch on these issues in greater length. But what can the government do then? So clearly there's a very important role for government in creating the legal and regulatory framework. Examples there have to do with protecting creditor rights, regulating business conduct, overseeing recourse mechanisms to protect customers. And one aspect there that generally tends to be overlooked is how important competition policy is. So competition, actually healthy competition, is generally a very important part of consumer protection because it does sort of increase consumers' market power, but also importantly, it provides the institutions with the incentives to serve the underserved. It provides the private institutions with the incentives to adopt the technological advances, to sort of generate new sort of products that make use of our new understanding from behavioral economics. So it's a very important aspect of actually increasing sort of inclusion in a responsible fashion. And some of the work we've done as part of this study suggests that actually lack of bank competition diminishes firms' access to finance. So using data both at the bank level, at the firm level for 53 countries over the 2000s, we do see that, and capturing lack of bank competition by the Lerner index, which is the markup over marginal cost, we do see, for example, that one standard deviation increase in the Lerner index leads to about 5 to 6% reduction in the probability of a firm having access to finance. So this is consistent with our understanding of better competition leading to greater firms' access. Another important issue is the role in supporting information environments. So standards for disclosure, transparency, promoting credit bureaus, collateral registries. Again, another study that we sort of summarize in the report looks at the impact of introducing reforms of collateral registry for movable assets. So from our database of doing business, since 2004, we have a good sort of list of all the reforms that were undertaken for 185 countries. So looking at, again, reformers of collateral registry for movable assets and comparing the reformers with the non-reformers matched by income and region, so that is sort of like a diff and diff approach, we can see that registry reformers, those countries which have reformed their registries, we see that the percentage of firms with access to finance increases again significantly. There's about a 10% differential increase. And these things hold after controlling for firm characteristics and country and time effects. And there's also even some evidence that the results are much stronger for small firms. So again, additional evidence that governments can do very well in terms of promoting, supporting the information environment as well as the competition policy. But the bulk of the report, actually, we focus on three areas: the promise of technology, product design and business models, and financial literacy, because these are the areas where there has been the most recent advances in terms of empirical findings and suggestions for the way forward. So let me now go over them each in turn. In terms of promise of technology, we all know that technological innovations have the potential to reduce transaction costs and increase financial security. Examples are biometric banking, payments, and so on. We know that, for example, in Africa, mobile technology has certainly led to a widespread use of mobile payments. This is one way that in Africa financial inclusion has been spreading. But many of us are not as familiar with other ways that technological advances have led to increases in financial inclusion. One other such innovative delivery channel has to do with correspondent banking, which again uses a lot of the communications and technological advances. And correspondent banking refers to having post offices, supermarkets, gas stations act as banking agents. For example, Brazil has been able to expand financial inclusion in the Amazons through the floating banks, banking agents such as this. Another important area in the way technology has been impacting inclusion is through greater identification. For example, a randomized experiment among paprika farmers in Malawi, where the lenders were able to distinguish between borrowers because now they are able to fingerprint them, led to very interesting and significant results. As you know, not being able to identify borrowers makes lenders restrict their supply of credit. So by improving personal identification, we were able to look at, what was the end result, and this is a paper by Xavier Ginet and his co-authors, and what they find is that for the worst credit risks, individuals, the repayment rates improved significantly when they were identified. And these individuals were also much less likely to borrow larger amounts, and they were much less likely to divert the resources to different uses after they having borrowed. So both the moral hazard and adverse selection was reduced for these individuals. So in a way, being able to sanction bad borrowers and reward good ones has the incentive impact for the lenders of potentially expanding access to finance. So this is another way that technology is helping. Anyway, so in order to summarize this point, it's important to be able to harness the promise of new technologies, and the regulators really need to allow this to happen. And but obviously, one of the important issues underlying this whole thing is to ensure that this is coupled by strong, prudential, legal regulation, as well as the information and training, which I will mention in a moment. All right, so the second area where there's a large number of studies, again, has to do with the product design and business models drawing on all this behavioral economics, which I will sort of talk about a couple examples here. One has to do with the introduction of commitment accounts. These accounts are accounts where access is only possible after a certain time. So again, studies in rural Malawi suggest that those farmers who were given access to commitment accounts actually ended up saving more, and also this was associated with greater agricultural use as well as greater land under cultivation. What's more interesting than this, though, is the fact that there was a difference between having access to a regular account versus a commitment account, where a commitment account had a much greater impact. And when the authors studied what was the reason, what was the mechanism was that the commitment account protected actually the individuals from their own social networks. And obviously this has impacts on the remainder of the network, but again, further studies suggest that's rather minor, and so this is a very important way that makes use of the behavioral economics in order to expand access by designing the product accordingly. Another example has to do with, again, insurance and the introduction of the index insurance. Now, insurance products are generally very difficult to design for use among the vulnerable population, simply because the providers have a very tough time assessing risk, and this makes them price the product very high, much higher than actuarially fair value. So either the product is very expensive or doesn't exist at all. And so one way of dealing with this was to introduce a product that was actually indexed to rainfall in agriculture. So by making this payments sort of conditional on the rainfall, you reduce the moral hazard, because at least you may pretty much get rid of it, because the farmers can't control the rainfall. So when this product was offered and when it was taken up, it was indeed very much, again, sort of associated with good outcomes. So it did lead to greater investment in higher cash crops, and good outcomes. But the trick here was that the take-up was very, very low. So while the product itself is useful when used, clearly it's very complicated for individuals and farmers to understand. So when the researchers studied it more, they saw that one of the reasons that there was very little take-up was lack of trust. You're trying to get money from an individual in exchange for money later, and nobody generally trusts you or even understands what the concept of that means. And there were issues of how to deal with that. So also further sort of products, try to design the product to pay often and fast and have an endorsement by a well-regarded institution, also simplify it and educate the consumers. So this is another sort of example of how designing such products can be challenging. So a final example I want to mention in this area has to do with a very innovative business model to expand access to the poor. And this was a very unique natural experiment where about 800 bank branches opened simultaneously in pre-existing Electra stores. This was called Banco Azteca. And these branches actually focused on previously underserved low-income clients. So they were able to essentially utilize this sort of leverage their existing relationships to start serving these clients in a sort of a favorable or profitable manner. And a diff and diff sort of, this is a paper by Miriam Brun and Ines Alal, which is forthcoming in the Journal of Finance, and it essentially shows that there has been an impact of this sort of access to finance on the percentage of informal business workers, and as well as the branch openings leading to an increase of employment and also income levels. So there was a significant impact in areas where these branches opened. All right, so the final area that I want to mention is this financial capability literacy area, because while we do want to improve financial inclusion, expand financial inclusion, we certainly want to do it in a responsible way. And part of doing that in a responsible way is to ensure that the users understand the concepts and they know how to use financial services responsibly. And so after the crisis particularly, there has been a significant increase in the number of sort of financial literacy training programs and so on and so forth. So we were able to do some randomized evaluations of how these things are used, how they're designed, whether they're effective. And there are some interesting emerging lessons so far. So from randomized evaluations in Indonesia, we know that classroom-based financial education for general population does not seem to work very well. What is much more cost-effective and actually has impact is if the financial literacy is sort of targeted to the segments that need it most. And it's important when the intervention is made. It seems like these interventions work best when they are sort of presented at teachable moments. For example, when somebody is starting a new job or they are taking out a mortgage and so on and so forth. And they turn out to be especially beneficial for people with limited skills. It also is interesting that here it's important to leverage social networks. For example, if you're trying to teach children, if you also teach their parents, the impact seems to be expanded. We have this huge randomized evaluation now that is being scaled up in Brazil at a national level, which very clearly shows this impact. And then if you are, for example, teaching remittance senders, if you also teach the receivers, again, the impact seems to be much stronger and longer lived. The curriculum is important. You really want to sort of provide rule of thumb training as opposed to sort of providing too much information that sort of leads to overload and does not allow people to absorb the information. And another interesting area is the role of new delivery channels. For example, we have done an interesting intervention in South Africa where we've introduced financial literacy messages to a popular soap opera called Scandal. And this sort of soap opera was run for about 2 months. And this was an encouragement design, so there was also another soap opera at the same time that people were supposed to watch as a control, and they did not have any literacy messages. And indeed, after the fact, it seems like the soap opera and the messages delivered through the soap opera had some impact. The individuals were less likely to gamble or use hire purchase type of arrangements, which led them into getting a lot of debt. But the sort of downside is that really this sort of the effect was fairly short-lived. So you need to constantly repeat the messages in the soap opera to have this to be a long-term effect. So I do want to end by providing some main messages and takeaways from this big synthesis that I've provided. Clearly, what we find by reviewing theory and incorporating the empirical evidence, that individuals, particularly the poor, can benefit from having access to basic payments and savings products. So financial inclusion in that context can be important. But we do see that it varies very widely around the world, with poor people and young and small firms facing the greatest barriers. There is promising evidence that innovative technologies, services, business models, delivery channels hold promise for increasing financial inclusion. It's also very important to underline the role of policy is to address failures, not to try to push and increase inclusion for inclusion's sake. So the governments would be advised to strengthen regulations, improve information environment, ensure competition among providers, and educate and protect customers, so that the private sector has an incentive to embrace new technologies and new sort of products in order to expand inclusion. And we also know that while direct government interventions have backfired over the years, there is certain products that can be offered, like low-fee basic accounts, allowing correspondent banking, reducing very onerous sort of documentation requirements for low-income individuals, as well as sort of introducing government-to-payment transfers through bank accounts that could have an impact in expanding inclusion. Well, thank you very much. So I'm happy to take questions. And this is the report which is available on the website. So a lot more than I could talk about, actually. Many, many more studies. So.
Well, thank you, Asli, for that remarkably interesting and yet brief summary of a massive amount of research. I'm sure that people have some questions, so why don't you raise your hand and maybe stand up and speak clearly. Good, we have microphones.
Hi, is this on? I'm Marlene Kim from the University of Massachusetts, Boston. Thank you for a wonderful report and synthesis. I'm just thinking about a paper I heard about a couple of years ago where someone was reporting in Africa where land was the biggest asset. Women were hiding the fact that they were owning land because they didn't want their husbands to take it away from them, and it was their source of economic power and independence. So I'm wondering how financial inclusion works in some countries in that way. Is it that bank accounts give women more power because they can leave their husbands if they need to, or does it are they not participating in bank accounts, like you said, in the developing countries, because the bank accounts can be taken away from them by their husbands? So I'm curious how that plays out, if you know. And also, if financial inclusion should be used to increase gender equality so that women have other options in their countries.
We'll see how many we get.
All right.
If we get too many, then I'll.
Yes. Is this on? Okay. So clearly, land, to be able to use land as collateral is a very important aspect of being able to access finance. And many women, even many individuals in many countries, do not have their land tenure. And we had a conference, and Will Martin is here in the audience, last week for a whole week, discussing issues around land and how important it is land, and how allowing land tenures and improving land tenure and governance has an impact on both access to finance and productive investment in land. And certainly that's an area where the governments can make a contribution. And women's land ownership security is a very important aspect of that. Whether women prefer not to have bank accounts because that can be taken away from them, I'm sure part of it is that, but I have a feeling also from the interviews and focal studies that we've done, they tend to either use or think they have access to their husband's accounts, and they think that is enough. But we know that from other randomized trials that is not adequate, because oftentimes having your own account in your own name increases empowerment and has a much more significant impact on health outcomes and education outcomes. So I think both financial literacy and awareness training is useful, and also improving women's rights is going to be useful. Overall, across the world, women tend to be 15% less likely than men to have an account, but this is even more, the differential is even more significant in certain regions like Middle East and North Africa, as well as South Asia. So those are areas where we hope that greater attention to women's rights and inclusion would help development outcomes going forward.
I know that some banks in particular have policies that are designed specifically to protect those accounts that are made in the names of the women, so that against any kind of sort of pressure to withdraw, for example. And actually, I want to follow up and ask you more about these commitment accounts, just because you didn't really go into the detail on how the commitment accounts, as opposed to the normal accounts, protect the individual against the social network. And I guess the social network includes the family, so it's kind of related.
Yeah, I think the idea is that a commitment account is an account where you put your money into the bank, and it's like a safe box. You're not allowed to take it for a certain period of time. It could be a month, it could be 3 months. So during that period of time, when your relatives and your husband come knocking, try to take that money away, you have a good excuse not to give the money. And we see, and there are many studies that sort of try to look at the impact of these accounts in many different social environments. And I think a consistent result coming out of these studies is that this increases the extent of savings, because presumably it also improves the incentives of individuals to save, because they know that it's not going to be taken away, and they could be, at the end of the day, the sum could be used for some productive investment, or even if it is used for consumption, it's not taken away and used by the social network. So one of the concerns around this issue is whether this actually makes the social network worse off, because this was raised, but it seems like there's some emerging evidence along those lines that suggests that impact is not necessarily negative, or at least significant, whereas the impact on the individuals who are saving tends to be significant. When you have access to a normal account versus access to a commitment account, there's a significant sort of increase in savings and eventual increase in investment once you have the sort of access to a commitment account.
Next question, please. Yes.
I'm Wilco Bolt from the Dutch Central Bank.
Could you stand up so we can hear you better?
I'm Wilco Bolt from the Dutch Central Bank. I was just wondering about, can you be financially included but not having a bank account? So, for example, in Africa, the M-Pesa project, let's say, is that Kenya, I think? People use their phone to make a lot of payments and perhaps even receive the salary, but I'm not sure if that they have a bank account. So, and also perhaps the rise with this, let's say, the virtual currencies. So let's say Bitcoin is probably not the best example, but that is a way to, in principle, that's a way to pay for services and goods without having to do with banks. Is that also financial inclusion, does it always mean that you are banked, that you have a bank account, or are there, let's say, other possibilities there? And with the rise of internet stuff, do you think that is also a way to develop that?
Well, in the study, we capture all these different elements. So you can go into the website and design your own sort of definition of inclusion and look at the impact. Now, as far as we're concerned, it's important to have a secure place to save, and it's important to be able to scale up. And it's important to be able to distinguish formal inclusion from informal inclusion, because we believe that in order to have security, in order to have affordable access, in order to be able to scale up, it's important to start being part of a formal financial system. But as I said, the whole sort of the database includes all these different dimensions. And one interesting thing we see is that even if you have a formal bank account, sometimes we see that individuals save informally. So that's a very interesting finding, because it suggests that potentially these formal financial service providers do not provide the right instruments. Perhaps the accounts are too expensive, or there isn't enough of a flexibility in terms of withdrawals, et cetera, et cetera. So this sort of information allows individual institutions, given the right underlying incentive and institutional environment, to potentially develop instruments that would allow them to expand their services to the underserved population.
I think Reinhard wants to follow up with a question.
Yes. What do you think about the official position of the European Union, which has proclaimed that up to some time in the future, every citizen in the European Union should have a bank account?
I think the European Union is pretty close to that already, because if you have seen on that figure, the proportion of individuals having a bank account really rises quite steeply initially, and then sort of almost asymptotically with income. So to the extent they are in high income countries, potentially a very large proportion already has a bank account. Now, the point here is to be able to have access to a bank account, not necessarily for them to necessarily use one. But I think even that distinction differential is fairly small, I presume, in many countries that is in question here.
There are several people whose hands are up, so what I'm going to do now is collect 3 questions and then let Asli address those. So I have 3 people in the very back.
Okay, just
Wait
a moment.
for the microphone, please.
The question is this. In your index, you appear to exclude in developed countries the question of uptake of insurance for agricultural and disaster situations. And I'm wondering whether inclusion of that in developed countries might address things parallel to financial inclusion, given that subsidies and other design elements of these insurance programs have some grave distributional consequences, such as the belief, backed by a lot of evidence, that support for flood insurance in developed countries tends to redound to the benefit of very wealthy individuals. So it's a broad question.
You got that one. There's another person nearby there. There was somebody else.
you?
Yes, there he is.
Pedro Goulart, University of Lisbon. Do you, have you in the literature, have they measured well the consequences of this financial inclusion? I'm speaking about, for example, take the case of sharecropping. Sharecropping was basically one way of actually reducing uncertainty, and with these types of loans that are dependent on rainfall, maybe now one can move to some kind of fixed rent that, in a sense, theory would say that would give the person better incentives to work.
Relative to sharecropping, you mean?
Yes.
Yes. Okay, and then we have a third person over here.
Yes, thank you. Andrea Bollino, Professor of Economics, University of Perugia. From a theoretical viewpoint, I would like to ask you if you would like to elaborate on the concept of financial inclusion from the viewpoint of a public good that gives externality. It's clear to me from your presentation that financial inclusion gives a benefit to those who are included. Is there a dimension in your idea that also the other part of the society benefits from including those excluded? So you have a positive externality, pretty much like having, say, correcting environmental externality when you take away pollution from the world and everyone benefits. Thank you.
Why don't you answer these three questions? We have a few more.
Okay. Well, first on the insurance aspects, when we first sort of designed the survey, we certainly sort of had a significant amount of insurance questions as well, and in our focal sort of surveys, we realized that there is going to be significant amount of confusion in answering insurance questions, because in some countries there's universal insurance, in some countries there isn't. So while the data is included in the website, in various aggregates we do exclude that. So you do get some glimpses of use of insurance services. For one thing, it is fairly limited. For another thing, I think it's difficult to compare across countries because of these different, public insurance schemes. On the index insurance versus sharecropping, sure, I can see how various sort of these things can be substitutes in some cases, and I think there will be many more research pieces addressing the impact of sort of agricultural insurance on various outcomes. And every time I look at some of this literature, there's some new papers studying the role of insurance, both in terms of designing the insurance product, because as I mentioned, the biggest challenge in terms of the agricultural insurance has been increasing the take-up, because the farmers find it very difficult to understand the contract, and secondly, to trust the insurance, the index insurance provider. So once those hurdles are overcome, and two things that researchers and financial sort of providers are trying to do in order to overcome those hurdles is, one, to design the product so that it pays more frequently, and secondly, to have some sort of endorsement of these products by, I don't know, a village elder or another institution they're used to dealing with, and to have sort of education classes to train the individuals who might be using these products. So once those hurdles are sort of overcome, and index insurance becomes more prevalent and better understood, potentially I think there could be more studies to look at the impact of this on various outcomes, one being how this affects sharecropping as well. And finally, on the theoretical impact of financial inclusion, I think a lot of the development theories have at their core financial market imperfections. The inability of individuals to access financial services has a lot of implications, because then they are not able to borrow in order to sort of invest in their education. They are not able to borrow in order to take advantage of promising growth opportunities, which at the end of the day leads to lower levels of growth and higher levels of poverty. So to the extent you could provide financial services more broadly, then you are going to benefit the whole society, because we are all going to benefit through greater sort of growth and development. So that's ultimately the answer to your question.
I think didn't you have a question? Could we get a microphone? Please, Francisco, identify yourself.
On the relationship between the level of income, that is lowest level poverty, and lack of bank inclusion. Did you, in this correlation, tried also to look to the inverse correlation, that is the lack of financial inclusion, or particularly of savings, creates a lower level of poverty? Because it seems to me the explanation of why in a rich country depends, it seems to depend from the relative level of poverty, maybe is just, I don't know, because econometrically, I don't know whether there is an autocorrelation. I mean, if there is a relation between low level of financial inclusion or a financial exclusion and to be in the lowest rank of income.
Well, as I mentioned, the analysis that I showed there is just a partial correlation at this point, because we don't have very good data. It's just at one point in time a cross-country data set. Yeah. However, I do have an answer for you as well. In our earlier work, we have looked at this much more rigorously using more financial depth measures, which are still highly correlated with financial inclusion measures. And there we have used panel data, and we do find a very significant association between financial development and reduction in poverty, as well as reduction in income inequality. So this is a paper that came out a couple years ago with Ross Levine and Thorsten Beck in the Journal of Economic Growth. Now, obviously, financial depth measures are only proxies for financial inclusion measures. The relationship is not one-to-one, because you could have a society that has high financial depth, but still does not necessarily have broad use of financial services. So we do want to look at these issues much more carefully with, as we sort of progress and get more sort of time series data to see whether what we see with the financial depth also holds with the financial inclusion.
If I can follow up on that, because I remember those studies that you just cited, and one of the things that I remember, please tell me if I'm remembering right, is it also feeds back to your other point about how it was particular problems in government policy that were important, so that if you found that if you, let's say, made the environment more competitive, you got that as a sort of exogenous instrument was associated both with greater financial inclusion and reductions in poverty. Am I remembering? So that fits in with your other discussion of the policy limits.
Exactly. I mean, in those studies, we've always shown that greater competition is associated with greater development of the financial system as captured by financial depth, and therefore associated with growth and reduction in poverty. So to the extent that these results would translate into those as well over time, we will see the same.
We have another gentleman. Oh, good. You already have the microphone right there.
Oh, okay. I used to be a banker, but now I'm at the California State University. You made a point that the greater financial inclusion that reduces poverty and income inequality. That makes a lot of sense. My question is, could this also be used as an economic development tool You did mention that there are some externalities, but the question is it really significant enough to be able to use it as an economic development tool for poor countries?
The studies that we synthesize in the report suggest that the poor people could really benefit from having an access to payments and savings, basic payments and savings services. This is associated with all sorts of good outcomes, increasing their savings, their investment, their health, their empowerment. So certainly it is a very important component of development policy. It's not we're not only talking about firms having access to finance and therefore, having greater growth and entrepreneurship. We're talking at the very basic level, addressing health issues and development outcomes as well. So different types of instruments having different types of effects on different segments of the society. So it's yes, there is, I think, widespread evidence from many decades now that having access to financial services is associated with faster growth at every level, at different, both at the firm level, at the macro level, while cross-country evidence has always difficulties in terms of identification issues. More and more individual country cases with micro-studies also suggest the same. So I think we could put that issue to rest, that access to finance is an important component of the growth process. Here, what we're trying to look at is whether directly using financial services even at the individual level has development impact. And there, too, we're finding for certain financial services, such as the savings and payments, there's unrefutable evidence that these are beneficial. For insurance, there is some evidence, but it is more difficult to sort of compile because of the lack of take-up, that this has positive differentials. At the access to finance level, at the very micro level, it is difficult to tell because there is where there's mixed evidence. Micro enterprises and microcredit is not necessarily associated with faster growth, and looking at it at the macro level also suggests that is not associated with investment and growth, but it is associated with welfare improvement, so it can be thought of as a redistributive tool.
We have time for another question. I have one, but I'll wait. Go ahead.
University of Łódź, Poland. Thanks for very, very interesting presentation. I have very short question because it's very interesting for me. The soft determinant of financial exclusion or inclusion. This is religious and cultural determinants. Could you explain more detailed what is the impact of such determinants? Thank you.
We do look at some of the religious issues. Actually, it's interesting. This is more of an issue in countries where the majority of the population is Muslim. So we find that Muslims tend to be significantly less likely than non-Muslims to own a formal account. And this is true even for controlling for other individual and country characteristics. And but it's also interesting when it comes to borrowing, the effects is not that significant potentially because borrowing pressures tend to overpower the religious considerations. So we believe this is partly because Islamic financial sort of services are not as widely provided in these countries where the population is majority Islamic. So I think this is an area for further research to figure out whether there are demand and supply factors and whether these should be overcome, potentially with greater competition and better entry environment, you could essentially allow entry of Islamic financial institutions, and also with a greater competition environment, you would provide incentives to the existing financial institutions to develop and provide more Islamic sort of products to be able to serve this sort of population that could be demanding these services.
Let me ask a question. As I was thinking about all the various dimensions that you were talking about in your speech, it seems like there's a one way to cut this, which is local versus sort of regional or even international consequences of these accounts. So, for example, maybe, well, the local thing is, well, I'll save more myself, my incentives to save, my access to credit and what I can do locally. But then there's also being connected with my network of family through remittances or movements across regions, which might be helpful getting me money if I have a health problem or something like that. So is there a sense of what weight to attach to these kinds of things when we're thinking, let's say, about payments and savings, the most basic kinds of accounts?
This is, I mean, there is emerging evidence on this, which we were starting to discuss before the session. One of this whole mobile payments activities and the ease with which payments are made now, for example, in Africa, there has been new studies of trying to understand what's the actual impact of this on individuals. And one aspect that turns out to be most significant is not necessarily only being able to sort of move money from here to there, but the consumption smoothing and risk management aspects of this. So if, for example, you have access to mobile payments, which allows your son to send you remittances to you in the village when there is an adverse health shock or an economic shock, the study suggests that you no longer decrease your consumption as you would have if you did not have access to this sort of payments service. So it's very important for the poor and the vulnerable to have this access to a basic payments account, payment service, then with important consequences for consumption smoothing in risk management.
We're coming to the end of our time, and I think at this point, I hope you'll all join me in thanking Asli for extremely informative and stimulating discussion. Thank you.